You are about to make arguably one of the most monumental financial decisions of your entire life. I mean, buying a home? It's huge. Welcome to today's Explainer, where we're going to dive right into navigating the financial realities of buying a house, specifically in the great state of Nebraska. It's an incredibly exciting journey. But listen, to do it right and to ensure you're completely financially protected, you absolutely need the right tools before you even think about putting in an offer.
So, is your dream home actually budget-friendly? You've probably asked yourself this 100 times while you're endlessly scrolling through real estate listings on your phone late at night. And honestly, it is completely normal to feel this wild mix of thrill and, well, absolute dread when you think about that level of commitment. Buying a home is amazing, but let's be real. The second you start looking at the actual loan math, it can feel absolutely terrifying.
And it's terrifying for a really good reason. You are taking on massive real estate debt, which is a huge responsibility. If you get these numbers wrong, you aren't just making a tiny miscalculation. You're potentially setting yourself up for a long-term financial disaster. Look, nobody wants to eat instant ramen for 30 years just because they wanted a nice front porch, right? Knowing exactly what you'll owe every single month before you sign anything is literally the only way to protect yourself and your future wealth.
Now, a lot of people just go online, type mortgage calculator into a search engine, and use whatever generic national tool pops up first. Please, do not do this. It is an extreme danger. Generic calculators completely ignore the local realities of where you're actually buying. To get this right, you absolutely must use a Nebraska-specific mortgage calculator. Why? Because a national average tool just won't factor in the local numbers that dictate your real, actual monthly payment.
You see, Nebraska has its own totally unique financial landscape. We're talking hidden costs, things like our state-specific property tax rates, which, by the way, can vary wildly depending on the county you're in, plus local insurance rates and potential homeowners association fees. If your calculator misses these state-specific costs, it's giving you a false sense of security and a wildly inaccurate estimate. Relying on a national average means you will end up completely shocked at the closing table. And that exact shock, that leads directly into the house poor trap. If you stretch your budget blindly based on bad math, your mortgage is going to consume way too much of your monthly income. Sure, you might have a beautiful dream home, but you'll have absolutely zero money left over for savings, vacations, or, those inevitable emergencies. The main priority of using a localized calculator is exactly this: finding a home that fits your real budget so you stay financially safe. To avoid that trap entirely, we really need to demystify exactly what makes up your monthly payment. A Nebraska mortgage calculator acts as your ultimate guide here by breaking down this four-piece puzzle known as PITI. That stands for principal, interest, taxes, and insurance. Getting a firm handle on these four words is the fundamental foundation of mastering your housing budget. Your monthly payment isn't just one giant chunk going straight to the bank. Think of it in slices. The principal slice actually reduces your loan balance. That's the money paying off the house itself. The interest is the fee you pay the lender for the privilege of borrowing their money. And finally, taxes and insurance are usually bundled up and safely held in an escrow account, so they automatically pay the government and your insurance provider when those bills are due. Okay, once you understand those slices, you gotta understand how they change over time. And this brings us to a slightly intimidating word: amortization. Honestly, this just means spreading your loan out, usually over 15 or 30 years. What a good calculator shows you is that at the very beginning of your loan, your monthly payments are heavily skewed toward paying off interest. It's only later on that your payments shift to mostly tackling the actual principal balance. So why does that shift matter? Because as you pay down that principal, you are building long-term home equity. A good Nebraska-specific calculator lets you actually map out this exact timeline. You can visually see your path to building wealth, month by month, year by year. It even lets you test out scenarios, like, hey, does throwing an extra $100 a month at the principal make sense for my long-term goals? Let's look at how this builds into the critical topic of interest rates, using a standard $250,000 loan over 30 years as an example. A seemingly tiny change in your rate completely alters your financial future. At 6%, you're paying around $1,498 a month in principal and interest. But just a 0.5% bump to 6.5%, that pushes you to $1,580. And the total interest paid over the life of the loan, it absolutely skyrockets. $379,300. Seriously. If your rate is 7.5% on that exact same $250,000 loan,
That is the staggering amount of total interest you will pay over 30 years. You are literally paying significantly more in interest than the actual cost of the home itself. This proves exactly why rate shopping is absolutely crucial, and why playing with these numbers in a calculator before you talk to a lender is basically mandatory.
Now, the type of loan you choose also dramatically dictates that interest rate. Generally, you're looking at fixed-rate mortgages versus adjustable-rate mortgages, or ARMs. A fixed-rate loan offers long-term predictability. Your rate stays exactly the same for the entire life of the loan. An ARM, however, gives you initial savings with a lower starting rate, but it carries a very real risk of future payment increases as the market changes. Your calculator lets you model both of these, so you aren't just guessing.
So, how do you actually get the best possible rate to avoid paying all that extra interest? You've got to boost your eligibility before you apply. Lenders are going to look closely at your financial profile. You want to pay your bills on time to elevate your credit score, aggressively reduce any existing credit card debt, and lower your debt-to-income ratio, or DTI. A lower DTI proves to lenders you have the breathing room to handle a new mortgage comfortably.
As you're saving and preparing, you also have to factor in your down payment. A great Nebraska calculator is going to automatically remind you of this really crucial rule. If you put down less than 20% of the home's purchase price, you will almost certainly be hit with private mortgage insurance, or PMI. This is an extra monthly fee designed to protect the lender, not you. An accurate calculator estimates this added burden so it doesn't catch you totally off guard. But here's some really good news. Nebraska has amazing state-specific programs to help you out, which is exactly why a local tool is so vital. For example, the Nebraska Investment Finance Authority, or NIFA, offers specialized loans with lower interest rates specifically for first-time buyers. There are also state and local down payment assistance programs and housing grants designed for low to moderate income buyers or residents of specific Nebraska cities. In a lot of cases, these grants and assistance programs basically act like free money to help cover your upfront cash requirements or your closing costs. When you plug these specific local incentives into your Nebraska mortgage calculator, you instantly reveal your expanded purchasing power. Suddenly, a home that felt just a little bit out of reach might actually be completely affordable. And look, using the tool to figure all this out is incredibly simple and totally stress-free. It essentially boils down to 3 really quick steps. Step 1, just enter your estimated home price. Step 2, add your expected down payment. Step 3, input the interest rate and your loan term. That's it. In seconds, you go from completely guessing about your future to having hard, actionable financial data customized right to your situation. The absolute best part? It's a private planning tool. You can instantly compare different scenarios, like a 15-year versus a 30-year loan term, without any risk to your credit score. There's no credit check required to run these numbers. You can just play with variables, test out different down payments, and adjust the property taxes based on different Nebraska counties, all from the comfort of your couch. Once you've run the numbers and you're feeling confident, you'll want to get officially pre-approved by a lender who truly understands the Nebraska real estate market. To do that, you've got to get organized. Make sure you gather your recent pay stubs, W-2 forms, tax returns from the past 2 years, and at least 3 months of bank statements. Getting this ready early makes the whole process so much smoother, and it keeps you from frantically digging through old shoeboxes on a Sunday night. I really want to anchor our entire explainer today on this incredibly powerful quote from our source material. Financial peace of mind is not the absence of debt, but the presence of a well-structured plan. Taking on a mortgage is a massive commitment, but running your specific Nebraska numbers, it takes the mystery and the fear completely out of it. It transforms a scary mountain of debt into a clear, manageable, and highly structured plan. Which leaves us with just one final question to think about. Is your dream home going to be a financial fortress or a house of cards? Don't let the math terrify you. Use a Nebraska-specific mortgage calculator, account for those local taxes and programs, and take absolute control of your budget today. Because the path to your dream home starts with knowing exactly what you can afford. Thanks so much for joining me on this explainer, and happy house hunting.